Well, hello, everybody. Welcome to the next edition of Investor's Guide to Thriving with me, your loving Leafs fan, Larry Berman. It is that time of year again. The Leafs off to a wonderful start because they just are. They're always. Anyways, let's not get in too much into hockey. Well, maybe a little bit tonight. Um, it's pretty exciting time of year as we get into October. Seasonality markets have been weak all year. In our very special educational segment tonight with our guests from Bank of Montreal, we're going to talk about and answer the question: is it time to rebalance your portfolio? So we have Chris McHaney here with us, and he's going to take us through, the ABCs of basic portfolios, and then I'm going to answer the question tonight: is it time to rebalance? And we're going to look at a lot of different things. So, pretty exciting night tonight. And then, of course, as always, we'll answer your questions. We are here in support of benefit from our sponsors. One of our best sponsors, of course, has always been BMO Exchange Traded Funds. And if you guys have been following us for a number of years, you know that we do these things for a couple of reasons, but the primary reason, of course, is to give back to the community, giving back to the BNN viewers for being loyal fans, and for those of you who want to thank us, a donation to one of the two charities we support. There are a lot of great causes, without a doubt. Cancer at Sick Kids Hospital is very close to our family here at Q Wealth and ETF Capital Management, and Dementia and Alzheimer's research at the Baycrest Hospital and Foundation. Again, here, two great charities to support. There will be a link that goes out on the email following the segments, asking you for your support. Some of you may want to wait till the end of the series. Some of you may want to contribute every week. We have all kinds of people greatly thanking us. Ladies and gentlemen, we've raised over $500,000 in the decade that we've been doing these live road shows in recent years, the last couple of years. BMO has been a great partner and supporter of our charitable efforts. So, with that in mind, I'm going to bring Chris, who you see here next to me. Now, Chris is one of the portfolio managers involved with BMO Global Asset Management. That is a key part of running a lot of the BMO ETFs. We get a lot of questions, Chris, on BMO ETFs and how they operate. But one of the basic things of investing is dealing with a balanced portfolio and how you get that kind of risk balance for people. And for a long time, I've been saying that the 60-40 model was broken. Now that yields have moved up, there's some interesting things happening. But in that 60-40 portfolio, Chris, you'll know this probably quite well, being the manager of some of these ETFs. This has been the worst start to the year just about ever for a traditional balanced portfolio. So the natural question is it time to do something about it? So you're going to talk tonight about asset allocation and the all-in-one solutions that BMO has. So Chris, take it away.
Great, thanks, Larry. And as you say, asset allocation, one of those things that's tough to pin down sometimes for investors, but really is probably the most important decision investors need to make. If we go to the next slide, just a disclaimer before we get started. The usual disclaimer, we're providing information here. We're not providing advice to anyone specifically, but want to get information out there for educational purposes for investors to hopefully make some educated decisions with their investments and in concert with any professionals they consult as well. Okay, off the top, as I mentioned, probably the most important decision investors need to make is, what is my core asset allocation going to be? There's been numerous studies on this over the years, starting in the late 80s, early 90s. Similar studies have been done, much more recently. And what most of them find is that over 90% of a portfolio's returns, the volatility of those returns, is driven by an investor's asset allocation decision. So are you invested, what proportion are you invested in stocks versus bonds, Canadian equities versus US equities? That sort of decision making at a high level really determines what a portfolio's variability is going to be. So that volatility of returns, that level of riskiness in the portfolio really is going to be driven by that asset allocation decision. So, it's really the first question investors need to ask themselves is, what is my risk return profile that I want to nail down in my portfolio? And then decisions go from there and follow on from there. So really a very important decision for investors to make. And then once they do, what is my asset allocation? What exposure do I want to get? If you take a look at the next slide, luckily for investors, what we have today are all-in-one ETFs or asset allocation ETFs, a fairly new, offering in terms of the ETF landscape. But what are some of the benefits of this? It really goes back to the traditional benefits of ETFs themselves. Liquidity, so very, very liquid underlying investments, transparency in terms of knowing what you're getting in that portfolio, knowing what the weights are of the various components, and being able to look through on any given day as to what my portfolio holdings are. So that liquid, that transparency, and that low cost. So for the most part, asset allocation ETFs turn around and invest in those broad indices that ETFs became very well known for, those very low cost, broad-based type of investments. And so you can get an asset allocation ETF at a very low cost as an investor, and in some cases can be cheaper than what those underlying investments would have cost you if you went out and bought them on your own. A couple of other benefits of asset allocation ETFs specifically is it simplifies things for investors. If you think about, again, determining what that asset allocation is and then going out and buying those underlying investments to create that asset allocation, investors would need to buy, anywhere from 5 to 10, call it, different ETFs, and then have to monitor those ETFs over time as well. With an asset allocation ETF, you can do that all in one investment, all at one time. And then one added benefit of that is that this asset allocation ETF, for the most part, is rebalanced for you as well by that ETF provider. And we'll get into why rebalancing is so important as well. If we go to the next slide, just to take a look at what some of these asset allocation ETFs look like and what the underlying investments are. I mentioned previously, most of the larger ETF providers do have some sort of offering in this space. So, we put up the logos of some of the major ETF players here. Of course, BMO as well, we offer a lineup of asset allocation ETFs, and they tend to be risk differentiated portfolios. So think about that traditional conservative portfolio, that balanced, 60-40 portfolio you were talking about, Larry, and then higher on the risk spectrum as well, a more growth oriented that has a higher weight into equities. And even beyond this, we have an all equity portfolio as well for investors that don't want any element of fixed income in that asset allocation. So a wide variety of different offerings here. And again, most providers have something in a similar fashion that are risk differentiated portfolios. And as you can see here, about 9 different underlying investments in the BMO offering. So again, for an investor to go out and buy each of these on their own would take quite a bit of work. If you pay commissions to buy ETFs, could cost you commissions as well. And then, as I mentioned as well, the ongoing monitoring and rebalancing of these portfolios is actually a key benefit of doing it here in an all-in-one solution. If you think about if you were a 60-40 investor, if you wanted that balanced portfolio and went out and bought all those underlying ETFs yourself to create that 60-40 mix, over time with market movements, that 60% allocation to equities is going to change. And if equities are rallying, that 60% allocation could move up to 62, 64, 66, what have you. And so what you're getting all of a sudden, if you leave that over time, the risk return characteristics that you signed up for as an investor really aren't there anymore. They're starting to change. You know, if that equity weight gets too high, the risk embedded in that portfolio becomes a lot more than what you might have originally thought of. And so being able to buy an all-in-one solution that maintains that 60-40 balance or 80-20 or whatever it is you're looking for, and can maintain that for you over time, because that ETF provider is going to do that rebalancing for you. If we go to the next slide, another benefit of that automatic rebalancing could come in the form of added returns. Again, another study done here shows that over the long term, and this is almost a 20-year study here, rebalancing your portfolio on a systematic basis actually can add, you know, up to almost 1% of returns in your portfolio. And if you think about it, you know, intuitively it makes sense. If you're doing a rebalance, and again, this is whether the fund is doing it for you or whether as an individual investor you have the discipline to review your portfolio on a consistent basis, whether that's quarterly, semi-annually, or what have you, and rebalance back to those target weights, again, whether it's 60-40, 80-20, or what have you. What you're doing when you're doing that rebalancing is you're going to sell down the investments that rallied over that previous period, and you're going to buy or reinvest in those investments that have gone down or haven't performed as well over that period. So, you know, around the fringes, what you're really doing is buying low. You're buying those investments that have sold off, and you're selling high. You're selling those investments that have rallied. And so you're locking in some of that drift that I was talking about as equities rally. You know, equities become a greater portion of your portfolio. If you rebalance back to that target weight, you're taking some of those returns off the table and really banking that. And then as investments, you know, revert to the mean, so to speak, you know, you gain additional return potential because of that. So, you know, something that shouldn't really be overlooked is that auto rebalancing feature. Not only does it make you stay true to your risk return profile that you want to maintain in your portfolio, but that added benefit of potential added returns as well. If we go to the next slide, really, this is just demonstrating that transparency element of an asset allocation ETF. Again, depending on who your provider is, most providers show those portfolio weights and what those portfolios are holding on any given day. You can go to the website of an ETF provider and see what's in that portfolio that you're holding. Each of these underlying investments in these asset allocation ETFs, as I mentioned, tend to be those broad-based index-linked ETFs. And so you're buying hundreds and hundreds of securities within each of these underlying holdings. And so going back again to the very beginning, creating that asset allocation, determining what those underlying investments are, you can go out and buy each of those underlying investments, again, with 5, 6, 7, 8, 9 different holdings. Or you can buy one ETF, and this ETF here, as you can see, holds over 4,000 different securities within it. So an instantaneous diversification into your portfolio. It's one line on your statement, one holding that you're actually looking at, but you have over 4,000, in this case 4,700 different securities underlying that investment, and you've done it all with one purchase, you know, as little as you want, you know, call it $100, $500, whatever it is. You have that global diversification within these asset allocation ETFs. Next slide, we put up an example of you know, the balance, some of those balanced ETFs that are out there. You can see, you know, on the left side here, there's 3 different lines there. I know it's hard to tell, but there's actually 3 different lines there showing the balanced portfolio of 3 different ETF providers. And so you can see very similar risk return characteristics across those 3 different offerings from different providers. In terms of why these are important, if you go to the next slide, what we're showing here is that investing has changed over time, and over the last, you know, call it 20, 30 years, significantly so, largely due to the fixed income yields that we've seen in the market being so low over those last 20 years or so. But really, in order for a given level of risk, to get the return that an investor wants, there's a lot of different investments that have to go into that underlying portfolio, simply because you can't rely on just fixed income anymore. And maybe we can start to do that, and Larry will get into that later. But in terms of getting that return potential and staying diversified as possible, you really have to add in a lot of different elements into your asset allocation mix. And so again, simplifying this approach, using an asset allocation ETF takes care of most of these for you. And then as an individual investor, you can think about adding on around that core that you've already created to add in some of these other potential investments that you want exposure to as well. In terms of what we have offering here at BMO, I mentioned we showed the first three on one of the previous slides. Overall at BMO, we have 6 different offerings going from the conservative, balanced, growth, and all equity. So 4 different, very similar investments in terms of the underlying investments, but different risk differentiated buckets there. We also have, for investors that want that ESG lens, ZESG on this slide on the bottom left there is a balanced portfolio. It mimics that 60-40 type portfolio, still uses those broad indices, but uses ESG screened indexes from MSCI. And so, for investors that still want that 60-40 portfolio, still want that asset allocation vehicle, but want that ESG lens on it, that's an offering as well. And then lastly, in the bottom middle there, ticker ZMI, this is another balanced risk sort of profile, but it's a more income focused type of investment. So instead of those broad-based indices underlying, the S&P 500 TSX Composite, this one invests in more dividend-oriented portfolios. So similar asset allocation in terms of geographies, as well as in terms of risk control, similar to that balanced portfolio, but we're investing in dividend-oriented stocks, more corporate bonds on the fixed income side, so more income-oriented investments to create a nice income solution there. And as you can see, all of these offerings at 18 basis points. In a few cases here, that 18 basis points is actually lower than what you would pay by the underlying MERs of those underlying investments if you went out and bought them on your own. So you're getting the benefits of that simplicity and that auto rebalancing essentially for free. And then the last slide, something I alluded to, that way to tilt your portfolio into the other investments you want. Certainly a lot of investors are active investors, want to create their own portfolios and their own exposures. If you use that core satellite approach, this asset allocation ETF can really be that core of your portfolio. So again, one line on your statement, one holding to worry about, but your core of your portfolio has that long-term risk return profile that you're really looking for. And then you as an investor can go and add on these satellite positions around that core portfolio. If you want to be a little bit aggressive, a little bit more aggressive, you can add on a couple of equity components. If you want to take a little bit of risk off, maybe add on a little bit more fixed income exposure or what have you. This really gives an investor control over their overall portfolio, but still maintaining that core for them in terms of what they can offer and what the risk return characteristics look like. So maybe Larry, I'll leave it there and turn it back to you. And you can, again, continue on this discussion of asset allocation and is it time to rebalance?
Yeah, no, that's great. I got a question for you because what I'm going to talk about a little bit about anyways is the type of investor that you are. So Chris, what type of investor are you? 60-40, 80-20? How about the new BMO ZEQT that's 100% equities? Like where do you fall on the risk spectrum?
Yeah, I would say personally, I'm probably that 80-20 type investor. I'm probably that growth-oriented investor. Unfortunately, I'm not as far from retirement as I used to be, so I do want a little bit of fixed income in there. I do want a little bit of stability in there. We do note that most of the interest is in the growth, balanced growth, and then that all equity type solution. So most do-it-yourself investors probably have a lot more time to their investment horizon, and so like that equity tilted portfolio.
Well, that's a good point. As I said at the top of the chat today, this is the worst start of the year for this 60-40, risk parity type portfolio. the bond market was supposed to be the safe part of your portfolio, and depending on where you look in the world, it's been a bad period. But I started saying, I think, Chris, back in around 2016, when we first started to see international bonds in Japan and Europe trade with negative yields. And I said that, going forward, it was going to be very difficult for that part of the portfolio to provide the safety for the average investor. I love these ETFs at 18 basis points. It's an unbelievable deal. And I had said a number of years ago that the robo advisors that were starting up, they were gonna fail because of ETFs like yours, because what that robo advisor does for you is basically what these portfolios are doing, and actually at a higher cost. So, great innovation from the ETF providers out there, from BMO and the others, and it's really exciting. Weekly, BMO does on their YouTube channel, weekly ETF market insights. I know you've been a guest on that show. I've been a guest on that show. I think for investors out there who really want to benefit from the educational aspects of what I do and what BMO does, that's something that you want to subscribe to as well. So, Chris, thanks very much for your time tonight. And then let's give it a Go Leafs Go. Can I hear a Go Leafs Go?
Go Leafs go.
All right.
Thanks very much, Larry.
All right. Thanks, Chris. Okay, so if you haven't already, again, YouTube is the repository for all our educational material, and please follow along, subscribe, alerts, whatever it is that you do on YouTube. I think I follow 2 or 3 people myself, so it is great when you have that new content and that alert show up on your phone or your tablet or laptop. Anyways, so this week, our agenda is really, I'm going to look at, is it time to rebalance? And the answer to that question is the essence of it is kind of what I started to ask Chris about. Is it time for you to do that? And the answer is, it's going to depend. And as I've said many, many times in public, on BNN, in these webinars, the answer to that question is very much about who you are. Last week in the webinar, I talked about all the mistakes I made, but really emphasizing that have a plan, a financial plan, a trading plan. That's going to help increase your investment IQ and reduce your investment EQ. And the EQ being the part that kills us, that emotional part of the decision-making process that, often leads us astray. And it's a big part of why I talk about the behavioral finance aspects of trading. Tonight, we're going to cover a little bit of that in the rebalancing discussion. But then we're going to talk about a lot of questions have come in over the weeks about inflation. And of course, this is earnings week. We're officially starting earnings on Friday. There's been about 25 companies already that have reported for the S&P 500. Pepsi reported this week. When I listen to these reports and these conference calls and look at the transcripts, it's very important what these companies say about, the go forward. And what Pepsi said this week is basically, I'm paraphrasing, and I'm trying to be a little bit entertaining as I do it. People are still eating junk food. They didn't say that, obviously. They're not calling their product line junk food. People are still eating junk food. We can raise our prices, and it hasn't been a problem. So we're raising our guidance. That's where I was going with this. And so I think we have to listen for that during earnings period as to what to expect. So I'll cover a little bit of that, and we'll get into some Q&A and hopefully, go back to rooting for the Leafs. That is, if you're a Leafs fan. I know many Canadians. I know many of you are not the Leaf fan that I am, but you're going to hear it from me this year because this is our year. So, I'm borrowing a chart here that Chris had put up. And, when you look at 40-60, 60-40, 80-20, the new ZEQT, which is all equities, and then you could get as defensive as possible and going into all fixed income. Of course, this year, fixed income hasn't protected. And it's partly why in the last year or so, we talked about alternatives, ways to protect yourself. Remember, folks, there are great ETF products out there that are equity exposure, but give you a balanced risk. We talked about those innovator ETFs over the last couple of years. We talked about using options to generate alternative kind of yields. So what we're talking about tonight here is the very basics of the average portfolio for the average person. If this is all you're doing, it's adequate, right? It is. There's nothing wrong with it if this is all you're doing. But you could be doing so much more. And I really think the future, it has to extend beyond the generic type of balanced portfolio and include alternatives, include strategies with options to generate yield and other ways to protect. And this year is the poster child for that. Now, again, to answer the question, is it time to rebalance? Last week, we talked about the emotional quotient, and that is the voting. That is the getting caught up in the volatility of markets and ignoring the weighing, the bigger picture, the more thoughtful, how should my portfolio be positioned? And, these ETFs are great for the average person who doesn't want to spend a lot of time at this, but does want to be a bit proactive. And so you've done your plan and you think about, okay, the average risk I want to take is about 60% equities and about 40%, fixed income. And this year, that portfolio is down over 20%. So you're not feeling good about it right now. But the question is, forget about the rearview mirror, okay? Can't do anything about what's happened. We always have to think about the decision-making on the go forward. And we want to be opportunistic, and we want to rebalance our risk when the opportunities present. And at the very basic level, if you've defined yourself as a 60-40 and you feel now might be the time to take more risk, you can hold that 60-40, and then BMO 4 times a year is going to rebalance that back to target. And as Chris showed, and as all the academic research has shown, systematically rebalancing your portfolio. When equities have been strong and bonds have been weak, sell some equities, buy some bonds, go back to that target, and vice versa. So this year, equities and bonds have sold off about the same. You're not getting quite the same amount of benefit of rebalancing. You are a little bit, don't get me wrong, but it's not as powerful as when, stocks are down and bonds are up, right? This year, they're both down pretty hard. So if you're going to rebalance now and want to take more risk, you may consider selling your ZBAL and trading up to a ZGROW. And if you're a ZGROW core investor, you might consider selling your ZGROW and buying ZEQT and getting all equities. But if you feel that more downside is coming and you're still at your 60-40, then you may want to trade down a notch to the 40-60. Again, you're going to take a little bit less risk doing that. And I would argue that bonds are better value today, certainly than they were a year ago, and certainly when they were 2 years ago, at the depth of the COVID crisis, prior to, Pfizer Monday, when equities were still, beaten down a little bit from the pre-COVID levels. And you just didn't feel good about, the markets. But obviously, in hindsight, that would have been a great time to take more risk. So buy low, sell high is really something that, I've had as a philosophy, and I talk about it and teach and try to educate people on how to think about that. So, is it time to stop paying attention to the voting and the noise in the market and start thinking about rebalancing and the weighing the next 2, 3, 4, 5 years? And I think it probably is. Every week that goes by, the closer we get to that terminal rate of the Fed tightening and taking the punch bowl away, the closer we're getting to one wanting to and should be taking more risk. One of the indicators that is not actually part of my Pro Eyes series, but from time to time is very interesting. The problem with this indicator, it's reported at a significant lag, meaning when we're looking at short interest, it's not kind of a real-time number. So Bloomberg, as a calculation of short interest, it's basically done by the New York Stock Exchange, and it's done with a little bit of a lag. It's not a huge lag, but it's a little bit of a lag. So like the sentiment numbers, when you look at the AAII and they do a survey and then they report it, and by the time it comes out to the public, it's like a week old. So, it's that kind of thinking. But this is the total short market interest. So the number of percentages, not percentage, but total value of shorts. And you can then put this over the market cap of the index and get a ratio. But you get the idea that when the market is, heavily shorted, that you're probably already positioned at a low. And when the market is a very low short interest, you're probably closer to a high. This is one indicator of many that you could look at, but it's of particular interest now because the level of aggressiveness of shorting at the June low compared to where we are today is not quite the same. When you look at anecdotally what insiders are doing, you're actually starting to see a pretty big uptick in insider buying as well. So that shows you the guys in the C-suite, are thinking about the value of their own stocks, and they're kind of doing something about it. And I'll comment a little bit more on this tonight as we get into the earnings and looking at earnings season and what's going on there. In our Pro Eyes indicator, in our tactical sleeve, we're now at a level here, and apologize for the chart not showing up properly. But it's oversold, as you could see. It's in the opportunity bounds. And as we go back, you can see this is the lowest level that the tactical risk monitor has actually got to. And the last time I commented on BNN last week about it, it's the lowest it's got to. Now, last week was the lowest it got to, and now this week's is even lower. So you don't know without the benefit of hindsight what that low ends up being until it's actually a low. And what I commented on BNN was basically that, the last time we saw these levels was, just after Lehman Brothers in early October of 2008. And while it was extremely low at that point, the market still went another 20% lower before the index, this indicator, actually bottomed. So there's no guarantee here whatsoever at all that this is a bottom or the bottom. But it does tell you that things are extremely oversold, and that if we do get a catalyst for good news, i.e. inflation numbers starting to improve, so I'll talk about that tonight, that the market is set for a rally. Last week, we saw a, Lael Brainerd said something. Like, you saw the setup there, and the market ripped for 2 days, and then nope, it's a bear market bounce, and they sold it off again. And after non-farm payrolls on Friday came in this much worse than expected, folks. This, not even that much. See one of these hairs? There's still gray one over here. That it was that much worse than expected, and then the market sold off. Now, maybe it was anticipating the inflation numbers this week, maybe it wasn't. On Friday, we get retail sales number. The retail sales numbers are turning down. It is clear that we're seeing economic decay. From the aggregate output numbers, aggregate demand numbers, that's starting to turn down. Yet the Fed wants to talk down, inflation. And so let's get into that. Is it sticky or is it transitory? Right? So we got a great, cute picture here of Powell with his, Volcker, good guy, bad guy, and, kill him, don't kill him. It's your legacy here. Be gentle. So I've always found that kind of point, counterpoint. Well, on one hand, well, on the other hand, do this, do that. Effectively, inflation is a mindset, and the expectation of inflation is a mindset, and the Fed knows this very, very well. This week, Ben Bernanke and some of his colleagues were given the Nobel Prize for their work on, liquidity and, preventing the downturns, and basically helicopter Ben. The MMT, the monetization of debt, the understanding that in the 1930s, if they made the wrong mistakes by pulling liquidity out, so they got to push liquidity in. Well, we've done that for a decade, and now we've pushed so much liquidity in on the monetary side, but also on the fiscal side. As you'll see in the inflation charts I'm about to show you, it was the last push in by Congress, led by the Democrats in the states, that probably wasn't needed, but at the time the economic numbers were weakening, that really caused, it's the last big amount of money they gave to people, $1 trillion-ish, that really unleashed that inflation genie. Putin made it a little bit worse, but again, you'll see from the charts that was marginal. It was well underway, and it was the combination of these guys saying transitory, 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 don't worry, don't worry, don't worry, and the average person kind of saying, I'm starting to see prices go up a little bit here. And so, everything is basic economics, supply and demand. Aggregate demand, what we all spend our money on, and then aggregate supply, what we all work to produce, and the supply chains and everything else, right? So obviously the Russian-Ukraine war exacerbated things, made it worse. In the political season we're in now, Biden's going to be on the 6 o'clock news every night calling it Putin's inflation. And you're going to see Pierre Poilievre calling it just inflation. And frankly, it has something to do with them, but really, not a lot in a sense, because they had to do a lot being unsure of COVID and what that was going to start and stop and start and stop and so forth. So, we can blame it on people. We can be the armchair quarterbacks and sit back in hindsight. But the key thing here is the mindset changing towards inflation expectations, is the deglobalization of the world. You saw yesterday, 2 days ago, whenever it was, that the US came out against the semiconductors for China, and they're not allowed to buy some of these semiconductors. What's that going to mean? So that's part of the war with China on technology. That was part of the war that Trump started. That was part of the war and a message to China that maybe you better stop buying Russian oil or you can't buy our computer chips anymore. Like that thing. So the less globalization, this is going to notch up inflation. One of the things that has been a friend to inflation is the falling share of labor as a percentage of national income. GDP is also known as national income when you look at the income side of the ledger. And so inequality, capital share of income. So what our savings makes, whether that's dividends in a stock or capital in a company and the market cap of your company going up and you're making more money. So capital share of income versus labor share of income. That separation over the last decades has been a huge part of inequality, polarization in politics, and so forth. And if that is changing, if unions are getting stronger and that is going to rebalance, that was deflationary, it's going to be inflationary. So, I'm looking out a decade or two at the demographics, at all the different things. And while globalization isn't going away, don't get me wrong, just-in-time inventories are going to become just-in-case inventories. That might be a 5-year thing. It might be a permanent thing. It's going to depend on this, hegemony in the world with the US kind of leading the developed world and China wanting to lead the emerging world. Russia's part of that. Separation. Like there's some real things there to consider. I'm actually now rethinking my China investment thesis on it's one of the cheapest places in the world. I'll get into that in the coming weeks, but not for today. But I could have been very wrong on that call. So when we talk about the inflation mindset, we saw this week a survey that the Federal Reserve Bank of New York does, and it's a sentiment survey, and they ask people about their expectations of inflation 1 year from now and 3 years from now, okay? So again, this is not market-based pricing. This is not actual CPI. This is a sentiment survey on what are your expectations of inflation for you, Mr. Smith, Mrs. Jones, personally. And these are the numbers. So what we saw this month was that the 1 year number has come down. The correlation of this number to gas prices is huge, but we saw a slight uptick after a number of months of downticks in the 3 year, but it's still well contained at a very low rate. Again, they started doing this survey in 2013, so we got about 10 years of data here, and you can see that inflation expectations started to break out. If you're talking about charts around March to the Q2 of 2021. So what came there? Well, that was the last, kind of massive spending that we saw, Biden pass, and that really was the launching pad. Biden telling you anything different than that? Trudeau was doing it, not blaming the government, but policy mistakes get made and there's implications. And really that was one of them. But the other one complementing this was the Fed saying transitory, don't worry, transitory, don't worry. Meanwhile, consumer behavior had started to, notch higher. And so March rolls around here, February, Putin rolls into Russia. Putin rolls into the Ukraine. Inflation expectations had almost peaked at that point, and certainly longer term inflation expectations had already peaked. So that's interesting, isn't it? So again, keep in mind. So the next part of that is what I talked about, globalization and inequality. So I got a chart here that actually shows labor share of income. So there was a paper that was put out in 2017. I think it was I can't remember Fed source here, but you can find it on the Fed website, and I put a link to it there if you guys want to look at it. But it's talking about, you know, labor share of income, and this one is the one for Canada, but for the U.S., for other developed markets, you know, it's kind of all out there, and so for decades, and really since China started getting into the, you know, exporting of cheap labor business, labor share of income has started to come down. And that put tremendous pressure on wages, breaking of the unions, Reagan, Thatcher, you know, that kind of era in the 80s. And so, you know, that kind of trend down. Now, we could argue that trend has changed, you know, in the last decade or so. Some of the data certainly supports it globally flattening out, but rebalancing back to where it was when unions were strong, you know, that discussion is you know, what I'm thinking of the next 10 years. So I think the Fed, in trying to get inflation back to 2, is misguided, and it probably will settle in closer to 3 or 4 for the next kind of phase. And so what does that mean for you guys? Well, it means that you should think about the cost of you know, keeping cash. When Ray Dalio says cash is trash, it is, because unless you're getting more than, say, 4% for your cash, which you're starting to now, that inflation is going to erode that purchasing power. And you always have to think of cash, it's safety, yes, but it's purchasing power. And that is almost as important as you know, the capital preservation part. Really is part of that equation. We don't think about that way, but it is. And then the final thing we're looking at, whether we're inflation or deflation or disinflation, really, is the market-based price. And so in the last decade or two, there's been a swap market that's developed based on expectations for inflation. And it's a pretty deep and robust market. And you could price inflation on different time horizons. One of the Fed's favorite long-term inflation expectation is, what is the 5-year rate of inflation? So what's an intermediate rate of inflation, or a longer-term rate of inflation 5 years from now? And that's the blue line. And so you can see that really is still very well contained. Now, when they were in transitory camp, you know, that started to tick up again. But relative to where that number was, you know, even through the great financial crisis, that long-term inflation expectation was a lot higher. So that's something to be confident about. But in the short run, so what is the 2-year inflation swap on this? And look at that number and run it back. So that's running at around 2.8 right now. So both numbers are still very well contained, market-based swap of inflation. So what this contract does, if you did one today, 2 years from now, if inflation's higher than 2.8, you pay, and if it's less, you receive, right? And that's how a swap, you pay or receive based on the terms of the contract. So, you know, the market-based price says inflation is going to come back down below 3. And I think the market might be wrong here. Now, far be it for me to say the market's wrong, but that's just kind of, you know, what I see. Now, arguably, everybody else who's a professional in the world who thinks about inflation has an opinion on where it's going to be. And if they felt it would be higher, these numbers would be higher. So maybe inflation and globalization isn't going to cause all these things. And maybe all the debt in the world and everything else is just going to keep the average growth rate very, very benign, and that inflation will come back down to those levels. So there's a lot of discussion around this topic now, and I thought it would be very interesting to kind of throw my 2 cents in and give you some thoughts on that. Okay, earnings season. So this graphic here is a quarterly look at the S&P 500. Okay, so what we're looking at here is a lot of different ways to look at earnings divided by different investment factors, whether they're sales, so sales per share, earnings per share, EBITDA, cash flow, etc. for the S&P. So a lot of different ways to look at it, but I'm just going to focus on earnings per share tonight. So, in the bank last quarter, $53.63. This quarter we're in now is expected to be $57.26, and you can quickly see, looking at $3.50, and so you're looking at about 6% ballpark of growth. And a quarter from now, so fourth quarter that starts reporting in January, 56, then Q2 and Q3, and so 12 months forward, if we were a year from today, $232.60, if accurate, would be the actual. So the forecast looking out a year is for pretty significant, right, $28 or so of earnings growth. And so you're looking at 14%, 13.5%, earnings growth. Now, if that number holds and we actually get that earnings, then 1 year from now, the market is priced at little under 15 times earnings. And folks, that's not bad. It's not cheap, but that's not bad given where interest rates are. So, when you look at what things are priced for, now let's say that we go into a recession, the analysts are out to lunch, companies start downgrading their earnings, maybe not this quarter, but next quarter, US dollar is strong, that's going to hurt earnings. There's all these factors, not just sales, that are going to hurt it. But what Pepsi said today is we're increasing our estimates for sales, we're increasing our top line, we're managing our expenses. Part of that is firing people, part of that is spending less on CapEx and advertising and whatever else a company would spend on, so that they can maintain their EBITDA, right? Or in other words, earnings per share. So, the C-suite, of course, has to deliver, and until they start seeing that top line come down, that's when, if they can't raise prices and they got to compete on price, that's when the margin pressures are really gonna start. Now, definitely labor's a huge part of cost. Different industries, different percentages, but huge cost. And so to the extent that labor and price margin pressures are coming, absolutely. So is that a good number or not? I would argue it's high and it needs to come down. So what is the number going to be? Well, let's say there's no earnings growth. Now, in a typical recession, you're going to get somewhere between 5 and 15%, hit to earnings. COVID was different. The great financial crisis was different, but this isn't one of those kind of downturns. This is more cyclical and not really systemic. Now, again, guys out there are arguing for that, but I'm not in that camp. So let's say earnings are just flat and there's no growth to earnings, and companies are going to be okay at managing the EBITDA, and a year from now we're at 200. So what does that mean? Well, at an S&P 500 of where we are today, you're talking about approximately 17.5 times. It's a little bit expensive for a no growth world, and you would argue the multiple can come down a little bit on that. 16.5 is that long-term average. Given where interest rates are today, 16 and a half, 17 is probably fair value, for that multiple. So yeah, it's not terribly priced today. But if earnings start to turn down, that's where 3,000, 3,200, and so some of those lower numbers that you hear, because if we trade at a 16 multiple and we get a 15% hit to earnings, you do that math, you're at 26, 2,700 on the S&P, right? So is that going to play out? I don't know. It could, but I wouldn't price that in today. So the next leg down on the market, interest rates have to go up more to put stress on the multiple. Earnings have to come down more to put stress on the multiple. But earnings could fall and actually still grow a year from now, and the markets are pretty fairly priced right now. So that isn't going to do it in itself. The recession and earnings have to come down a lot and pretty aggressively, or interest rates have to go up another notch. And I would argue it's going to be hard to do that because the economy is already faltering. So, when we look at, how these numbers work, so there's a running number. Now, this is the 2023 year-end number. From the start of the year, earnings expectations, and so the Fed starts raising interest rates, they start doing QT, and all of a sudden, the numbers start to come down. But where we are today, the number is still higher than it was at the beginning of the year. And to me, that is fascinating, right? It really is fascinating. And anyways, that's really something to really contemplate and think about. I actually forgot to mention this point that I put this subheading in here. So let me go back a slide. Excluding the mega caps, right? The higher PE, big mega cap names, Microsoft, Apple, and so forth. If you exclude their weight in the index and influence on the PE, the rest of the S&P 500 forward PE is actually closer to 12x. And that tells you a lot too. The market is actually not that expensive here, okay? So something to keep in mind, especially when you pair that up with what the Pro Eyes is telling us about the degree that the market is oversold now, about what that insider behavior is, about what that short interest is, that the market is not set up here for better than expected news. And that could come through inflation numbers, it could come through a Fed speak, it could come through better earnings and better outlooks from corporations. Now, they're all going to talk down the numbers, don't get me wrong, but just not as worse as feared can be good news too at a point like this in the cycle. So what do markets do? We get a bounce from here, but make no mistake, we're in a bear market and we're not going to get any rip-roaring rallies to the upside. I was shocked that the August rally took us above the May and June highs. I was shocked. Behaviorally, that would argue we got a higher high or a lower low, but a higher high. And so the next low needs to be a higher high, and so far it isn't. But if we hold here, we then have to get above 4,300 for there to be a confirmation of a bottom. And folks, I would not hold my breath out for that at all. But if the bottom is in, inflation is contained, earnings come through, maybe this is the low, right? So that's the thing. So is it time to rebalance your portfolios? Guys, I don't know. My crystal ball is not clear, but there's an opportunity here, at least for a tradable rally. And if you want to play that, then the setup is there to take a little bit more risk here. Might it go down another notch first? Maybe. So let's see. Let's get into the Q&A. Got about half an hour left here. So when will tech stocks begin to rebound? It's hard to believe that so many platforms I use on a daily basis are still so down. I'm not sure what the writer means by platforms. Maybe that's ETFs. I'm not sure. Is the reason this is the case is because they were greatly overvalued. So maybe platforms are companies. I don't know. So I think yes. I said a year ago plus. I love the work that Kathy Woods, Kathy Woods, does with their ARC. I think the innovative, the disruptor, all that is a massive part of growth in the long run. The key thing is in the long run. But we go through these manias in markets where people get stupid and they pay stupid amounts of money. Kathy Wood's getting money throwing into her fund. She's got to put it to work. That pushes up prices. It buys the stocks that she wants to own, and they get stupidly valued. And that continues until it doesn't. And now the punch bowl's being taken away, and these companies are coming back to what I think in many cases are really good values. I wouldn't own all of them, but I own some of them today. I still think Tesla is very overvalued here, but again, discussion for another day. And maybe we'll get Kathy Woods on a call here, and I could debate it out with her for an hour and a half, and we could take some questions. That would be pretty cool to do at some point. So we'll see if we can arrange that. Because I really think what she does is really, really good. But that's the difference between a great company, a great disruptive technology, and a good stock. And a good stock is the price, right? So we're seeing a lot better value. I'm nibbling on the ARC ETF. I've written options to buy it. Do I love it? Am I fist pounding? No, but for a trade, there's some value here. If I start to have clarity that the Fed is done raising rates, that we're going into a downturn and all the bad news is priced in, then there's a lot of potential in those names again, looking out 3 to 5 years. And that's where you put your weighing hat on and you say, plug your nose, buy it. It looks ugly, the chart's gross, but the value is there. And if you look out, it makes sense. That argument didn't hold water a year ago, given what I was expecting on inflation and what the Fed needed to do. And today they've done a lot of it already. And so you start to think differently. So, good question. Don't know if I answered you or not, well enough, but that's kind of, some of the thought on there and what I interpreted your question to be. Can I please explain how the consistent interest rate increases work to slow or stop inflation? So ask yourself the question, and for the average person, maybe not everyone has a mortgage, but let's say you have a mortgage, and let's say it's coming up for renewal. So a few years ago, you locked in at a rate, and that rate was 2.5%, and now you got to lock in, and the new rate's 5.5%. So what did that mean? So let's call, again, very simple math, $1 million mortgage, but now you're paying 3% more for it. So that's an extra $30,000 a year amortized into your mortgage, but that's your annual cost. So you divide that by 12, and that's kind of how much extra are you paying, in your mortgage cost. Well, that's a lot of money, all of a sudden in extra cost for you. So, if you're doing a 5-year term, you're amortizing over 25 years. So that's an extra 30,000 amortized over 25 years. Again, you can run the math on that, and your interest rate payment's going to go up $300-400 a month. Okay, that's $300 to $400 a month less that you have to spend or put in savings or spend on your rent or anything else. And typically it's your discretionary spending. So, last year you were going out for dinner twice a week. We reopened. You were spending an extra $300, $400 a month, and now you got to refinance your mortgage, and you don't have that $300 or $400 a month anymore. So you stop going out for dinner. Maybe you stop smoking. Maybe you don't buy the $80 bottle of scotch and you now buy the $40 bottle of scotch. You do what you need to do. You have more mac and cheese per month than you do steak. You do what you do to save that money that now is poof up in smoke. So higher interest rates are a tax on discretionary spending. So I'm hoping I'm giving you a pretty simple explanation of it. But when inflation expectations, as I talked about tonight, gets out of control, what ends up happening is you get more people quitting their job, going to a new job for more money. So they have this thing called the JOLT survey every month, and they look at job quitters and wages and all those things that factor into labor. We talked about labor share of income. If the demand for me working for you is going up, that gets into corporate margins, but I'm not talking about, the stock market at the moment. I'm talking about, how does this stop inflation? So by them raising rates and hurting discretionary, in the short run, people demand more money until the point where the company says, you know what, I can't afford to pay you that. And yes, I need that person to do that job, but we're actually going to push that project off 6 months, and now I'm not hiring anymore. So I don't care about your labor demands. I'm not even going to hire that person. And so that hasn't started yet. Maybe at the fringe, it's starting a little bit in some industries, but it really hasn't yet. And that's in front of us, folks. So that they talk about the lagged impact of monetary policy transmission. You're going to hear that phrase come out a lot in the next couple of months. You heard Loretta Mester this week when she spoke. She's the head of the Cleveland Federal Reserve. When she spoke, you heard it from Barker. You've heard it from a couple of Fed speakers that they get that there's a lagged impact. In the Fed minutes that came out this week, they talked a little bit about that in their discussions. It was in the minutes. They're well aware that rapidly raising rates, as they have done, has not yet filtered into the mom and pop day and day. That's coming. It's coming every month as more mortgages roll off from the cheap rates to the more expensive rate. It comes in your rent's going up. So I paid $1,200 last month. I paid $3,000 last month. I got to renew now. It's $3,500. That's $500 less that you have to spend on those meals. And so you stop going out. And so the restaurants, they want to attract more people. Can they cut prices to get more people? Not if they don't have money. So them competing on a lower price basis might pull from some, but then that becomes deflationary. So that hasn't started yet. So are you seeing now, and I hope I'm explaining this well, but it's a great question. There are a lot of levers and a lot of things to consider, but it just takes time for that to get through the economy, but it's coming. And so you weigh the cut pricing to compete, the job losses and all that, and that just slows inflation dramatically. Great question. I didn't cover that in my talk tonight until now. TSX is on a multi-day losing streak. Are there any positive indicators as we move towards? So we talked about pro-I's being oversold. That's largely a focus on the US market. The Canadian market, very heavily weighted towards banks and mining and energy. Not as much as historical, but still a big component of it. So when we consider that aspect of things, and we look at this chart. So is there anything positive? Well, the TSX, within a rounding error, is back at the pre-COVID high. One of the things I like to do is smooth out trends, right? So going back to the low of when the TSX would have made a major low, and that's when oil prices were collapsing from 100 plus down to what they got to at the lows in 2016 before the rebound. Obviously, oil prices turned negative, COVID shock here. So those are major low points, of course. But the trend is your friend. And so we're now not only back to the pre-COVID levels or close to it, we're getting back to the lower end of the trend of the last, number of years. And often that's a point to buy, but you would have argued that might have been true here. So there's no guarantee whatsoever that the lower end of this and that old high is any support at all. No guarantee whatsoever. But it's better than it was up here. And folks, this is why over the years, my mentality has always been buy low, sell high. Because when things are richly priced and the charts look good and momentum, eventually it's going to turn. You just never know what it's going to be, but eventually it's going to be. And sometimes it's months and sometimes it's years. And that's the hard part about market tops. Market bottoms are relatively easy compared to tops. So what we look for at key support areas are things called divergences. And so when we look back at the lows made in June and the lows we're tracing out now, and we look at the RSI, relative strength index, so we saw lower here, but really now we're not seeing it. So the intensity of what's going on here is different than here. And so, is that a reason to buy? No, but it's another thing. So this RSI indicator is part of our Pro Eyes. Again, we run it on the S&P 500. But here for the TSX, you see something similar. So, you got to look at what makes up the TSX. Is that at a bottom? So banks. Are we at the bottom of the mortgage market that might impact the banks? Could there be a little bit lower there? The answer is absolutely. Is energy buy? If we go into a recession, our oil price is going to go up. I know what the oil bulls say. Oil supply, it's not going to be there, underinvest. I get all that. And it's very true. But that's a narrative versus what happens if there's a recession. And that's all true, what they're saying, but is there going to be more than an offset in lower demand? I don't know the answer to that, but I suspect you'll start getting a discounting in the stocks. So I would argue that we potentially have another leg down, I think in the US markets too. In the US market, probably not below 3,200 on the S&P. So, ballpark 10%-ish from where we are now. So let's call it 10% off here. That gets us down somewhere into this range, 1,700, 1,650. And at that point, really attractive to me. So are we there yet? I don't know. I don't think so. Is there a tradable rally here in the short run? Yeah, probably. How high is that rally going to be? Don't bet on it getting above 20,000 on the TSX. It would be my message there. So what sectors have performed well this earnings season? Are there any positive stories? Okay, so when you look at the S&P 500, again, I'm not looking at the TSX, folks. I do focus on the US market. It's 58% of the world. And to focus on Canada, that's 3% of the world, doesn't make a lot of sense. When you look at where earnings growth is coming from, it's the energy sector by far. In fact, all that earnings growth we're seeing over the next year or so a lot of it is coming from energy. Ex energy, there's actually not a lot of growth in earnings coming. So that's pretty important understanding here. And you can look at, the E&P companies, you can look at the integrated oils, you can look at the exploration and production, you can look at the pipelines, you can look at the refiners. There's different parts of the spectrum on the oil side. They're all delivering, some more than others. The E&P companies have more leverage to the price of oil going up. So if you're an oil bull, it's the guys that are drilling for the stuff that have more earnings variability compared to the integrated oils that do everything from refining, like a Suncor, to selling it to you at the pumps, so marketing. They call it the marketing side of it, the refining side of it. They have the exploration side of it. They're integrated. So there's less variability in those names, but they are levered to some upside here. So that's kind of where the bulk of earnings growth is coming from. And so there is a good story there. Question is it priced in already? And I would argue a lot of it is. But again, if you listen to the oil bulls out there, they're going to tell you it isn't. If you look at the analyst estimates, they got higher numbers. So, my weekly YouTube video this week actually recommended buying a ratio put spread for the bears. So you buy one put at the money, you sell two puts where you want to actually buy the XLE or the XCG, more liquidity trading the US names. So you buy one put and you sell two. That position costs you nothing because what you take in income from selling the puts, cost you to buy the protection. Market goes down, you make money. You sell your long position, you expose your naked puts, and you earn income or you ultimately get put. You get put at a better level. So I love that for the bears to buy a dip. And for the bulls, you buy a ratio call spread or just a call spread. And so it's going to cost you a little money to buy the pure call spread. But if you believe, like I do, we're going to be in a trading range, then you sell 2 units at resistance, you buy one at the money, it goes up, you sell your long position, you take your profits, and then you have to be willing to get short if it gets to those levels, or you earn the income from those. So that's what I really like here for the energy sector as a way to play it for the next few months. I saw this week that the IMF, so there's a typo there. So I guess it's the IMF, the International Monetary Fund, downgraded the growth forecast for Canada. In simple terms, can you explain what this means and how it will affect the average person? It actually means absolutely nothing. Everybody forecasts it. So whether it comes from the International Monetary Fund, maybe a few more eyes pay attention, or if it comes from one of the banks here downgrading, the economic outlook. Typically, these formal economic forecasts are lagging, not leading. You will never get a body like the IMF forecasting a recession until it's, there already. And if they're forecasting a recession, it's already in the market by a long shot. So these forecasts are practically useless from the perspective of markets. Okay, so very important learning there. What does it mean for the average person? Well, the question is there, what does it mean? Well, it means if we're going into a economic downturn, that you might have to be concerned about your job. So I'm not sure exactly what you're asking here, but I suspect you meant from a market perspective. But if we're going into an economic downturn or weaker, then things aren't going to be as good. If you're a business owner, maybe you should think about, cutting costs or whatever. right? So it could have some impact on you, from that perspective. There are currently lots of issues participating in the market correction. How big a factor is the Russia-Ukraine war in the overall picture? So I had talked earlier on tonight about the inflationary impact and them calling it, Biden calling it Putin's inflation. And as it pertains to what it did to the energy markets, sure. As it pertains to what the US had to do with the Strategic Petroleum Reserve, absolutely. As it pertains to the fact that the US will have to buy all that oil back, at some point, when they're going to do that, I promise you, will be in the next recession when oil prices are cheaper, not now. Like, it would be idiotic for them to buy it back anytime before the next recession. And that would actually provide a lot of underlying support for the energy oil prices, during a downturn. So that's pretty interesting, isn't it? So there might be an automatic stabilizer in there, and that Strategic Petroleum Reserve, if they get it big enough over time, could act as an offset to OPEC a little bit. I don't know if they want to day trade their strategic reserve, but anyways. But from a humanitarian standpoint, absolutely awful. For the exacerbation of what it means for the East-West divide and less globalization, hugely meaningful, for decades into the future. I don't see, until Putin's gone, until Russia officially changes their view on the world and on their ambitions for reuniting the Soviet Union, pre 1990, 89, wall falling, etc. Until that view changes, Russia's going to be increasingly isolated from the West. There's no chance that Europe's ever going to rely on Russia for gas and oil anymore. That presents a lot of problems. They're going to have to get it from the Middle East. They're going to have to get LNG from the US and from other jurisdictions. The world's going to have to rebalance. It takes a lot of time. I did a feature on BNN earlier this year based on a paper that one of the great strategists out of Credit Suisse, Zoltan Posar, came out with. And he basically said that, all the oil that would get shipped, on short-term smaller ships from Russian ports to Germany and offloaded, those ships now need to go to India, but they're not big enough and they need bigger ships. And so all that kind of takes time and it adds cost and it's inflationary. So the factor adding to core inflation globally, less globalization, more onshoring, it's inflationary. The more that accelerates, the more inflationary it is, that average expectation will uptick. I don't think that that's fully being reflected yet. And that's where I think there's two things as it pertains to inflation that, become sticky. One is the wage gain and the labor and the inequality and labor share of income that needs to recover for the world to get less polarized. So the average person needs to get paid more and corporate margins need to come down. That becomes easier with more onshoring because you got to pay more domestically than you did when that product was made with cheaper labor around the world and so forth. So all that needs to factor in, and that's measured in decades, folks. This war has accelerated the understanding of the importance and reliance on certain parts of the world for their products. What the US did, China relies a lot on the IP that comes from Silicon Valley. The chips are made in China. The chips are made in Taiwan. Okay, vast majority of chips. But the IP that designs those chips is based in the US. A lot of that IP might be someone from an emerging market origin or birth getting educated in the developed world and using that IP in Silicon Valley. But that is now US IP. Now, is that person going to go back to China or somewhere else? Just using China as an example, no, not picking on them, but as an example, and translate that there. That's a discussion, right? And so this is another great question too, and it's going to have an impact. It's going to be measured in years and maybe decades, and it means less globalization, which means inflation, upticks in the long run on average. It's going to be very hard to go back to 2 as a core rate, I think. So we'll see. Maybe I'm wrong on that. It's a debate to be had. There's a bull and bear everywhere, and as that guy says in the U.S., I'm trying to find it for you. So, folks, we're pretty much out of time tonight. I don't have time to go to another question, but again, promise you that we'll get to as many of them as possible. Maybe every couple weeks on these, I won't really talk at all about educational things, and maybe less, and take more questions. And so, we'll do those periodically too, because I know there's a lot of questions that come in, and we just can't get to everyone. And I like to get meaty on the questions, for sure. So, thanks again. Thanks to all our partners, our sponsors. And please, folks, consider making a donation to one of our charities. If you're learning stuff here, if we're helping you make better decisions, which improves your well-being and your portfolios, thank us by making a donation to one of our charities. Have a great week, everyone, and go Leafs go.